All right, and we're ready to record today's session. And let me share a screen. All right, your PIN is 2145442. Okay. All right, 4 people have joined us so far. 5. All right, that's we got 6 folks here and 6 folks playing. So let's begin. All right. First question. Which of the following would a registered representative be able to make for a customer in a non-discretionary account? 1, the time of execution of the trade. 2, which security to buy. 3, how much of the security to buy. 4, at what price to execute. Best answer A, 1 and 4. B, 2 and 4. C, 2 and 3. Or D, 1 and 2. Okay. Remember, the faster you answer, 12 points to score. Now for a non-discretionary account, non-discretionary means they don't have the authority to make choices on behalf of the customer. So if the customer provides, right, has to provide the 3 A's: the asset, the specific security, the amount, number of shares or dollar value, and the action, meaning buy or sell. With a non-discretionary account, the registered rep can choose the time and the price. Number 1 and 4 is the best answer here when it's a non-discretionary account. So notice it's not just one word that made the difference, right? It was a prefix that made the difference. Non-discretionary. Is there any part of that that's not clear? If you'd like to get more detail, please let me know. Okay, please unmute and ask the questions you need, because we want to make sure that you're all good. Okay. So explain one more time. All right, non-discretionary account. All right, that means the customer has not, or so the registered rep has not been authorized to make discretionary trades for the customer. Discretionary means they can, the customer is going to allow them to choose what to trade, what to buy or sell, how much to buy or sell, when to buy or sell it. Basically, the customer is just saying, you take care of business, do what you need to do. Now, remember, they have to give them a written power of attorney to do so. With a non-discretionary account, the customer must provide, right, the 3 A's. The 3 A's are the asset, the specific security to trade, the amount, meaning the number of shares or the dollar amount, and the action buy or sell. The only thing they can leave out of that is the price. They can let their registered rep use their judgment when they think the price is right. In fact, they call it the time and price exception. So they'll let the rep use their judgment. So buy 200 shares of Altria if you see the stock correct. I think I've mentioned that before, right? Okay, you got the action buy, the asset Altria Corp, and the amount 200 shares. They'll just let their rep determine when they think the price is right. That is not considered discretionary. It does not have to be in writing. Okay, does that work for you? Does that help? All right, thanks, Karina. All right, so let's check our next question. An opening transaction can be A, a buy open, B, either a buy or sell, C, a short sell, or D, a sell open. Trade can be a buy or sell, right? An opening trade means that's the first transaction in an investment that somebody makes. Now, the obvious thing, of course, if someone buys something, that's an opening purchase or a buy to open. When they get rid of it later, they sell out of it, that's a closing sale. Now, that's the obvious one. But remember, sometimes the first thing someone does is sell something. In a short sale, right? Yeah, they sell something that they don't have. That's an opening sale because that's their first transaction. They get out of that position by buying the stock back again. A closing purchase, opening sale, closing purchase. So it doesn't have to be a buy only or sell only. It can be a buy or a sell. Okay, let's see here. All right, it's Amy and Karina on the board. Let's try our next one. Mr. Smith has owned XYZ stock for years and wants to take his profit and invest that money in another stock. He should A. Sell XYZ to open. B. Sell XYZ to close. C. Buy XYZ to open. D. Buy XYZ to close. Good. Okay, exactly. Since he already owned the stock, right? He bought it years ago. He bought to open back then. Now he's ready to move on and invest in something else. So he'll sell XYZ to close, and with the proceeds of the sale, he'll buy something else to open until he wants to sell that too. Good. All right. It's Karina moving into the lead, and others, Ashley, Hannah, and Alicia on the board. A person who is invested with legal rights and powers to be exercised for the benefit of another is known as A, a sponsor, B, a dealer, C, a fiduciary, or D, a broker. Good, yes, a fiduciary. So with legal rights for the benefit of another, right? It's a fiduciary to that other person. The word fiduciary, right, comes from also the Latin word fidelis, meaning faithful. They must be faithful to the other person. As a fiduciary, must always put that beneficiary's interest ahead of their own at all times. A trustee of a trust is a fiduciary. An investment advisor is a fiduciary. Custodian for a minor's account, they are all fiduciaries. A power of attorney versus a fiduciary. A power of attorney, okay, a fiduciary has that legal rights to handle someone else's assets and must do so, right, as always putting that other person's interest first. Power of attorney is where someone who's, where the account owner has given someone else who's not on the account, but the authority to act on that person's behalf. But that's just as a power of attorney, not necessarily held to a fiduciary standard. So, like, of course, married couples will frequently grant each other power of attorney for each other's accounts. Okay. All right. Okay. A dealer. Okay. Remember, a broker-dealer firm. A brokerage firm is called a broker-dealer. Broker meaning they act as a middleman, as an agent on a transaction. As a dealer, that means they buy and sell out of inventory, right, for profit or loss. That's what as a dealer. Okay. Sponsor is another term for a wholesaler or underwriter of a mutual fund. All right, Colby moves on the board, and Karina's 3 in a row. Short sellers have A, limited profit and loss potential. B, limited profit potential and unlimited loss potential. C, unlimited profit and loss potential. D, unlimited profit potential and limited loss potential. Kind of an even split here, 2, 2, and 2, but as a short seller, limited profit and unlimited loss potential. Now remember, as a short seller, to sell short means to sell something you don't have. How do you sell something you don't have? They arrange to borrow shares of stock from their broker-dealer, and they sell the shares, get the money deposited in their account, but can't take that money out because they've got this obligation. They owe their broker-dealer shares of stock, maybe like 200 shares of AT&T or something, right? The plan is wait for the shares to drop in price, buy them back later when they're cheaper, replace what they borrowed so they don't owe anything anymore. That closes their short position, but they get to keep the difference. Now, the lower it goes, the more money they make, but there is a limit how far a stock can go, right? It cannot go below 0. So from this person's best perspective, right, the stock's worthless and bankrupt. They can buy it for nothing, after sold it at a certain price. But what if it goes up instead of down? Well, if it keeps going up, they have to replace what they borrowed at higher prices. The higher it goes, the more money they lose, and there's no limit or ceiling how high of a price of a stock can go. So in theory anyway, right, a short seller has unlimited loss potential. Now, a long purchase would have unlimited profit and limited loss because you can't lose more than the amount of your investment than you bought it for. but it can go up conceivably to infinity. Okay. All right, Alicia moves back on the board. Let's try our next one. Which of the following orders can be used to close a short position in CDT stock that consists of 1,000 shares? Okay. A, write 10 CDT call options. B, sell 1,000 shares of CDT. C, buy 1,000 shares of CDT. D, buy 10 CDT call options. Pretty good, yes. So they closed a short position. Now remember, there would be an opening sale, right, to sell something they don't have as a short sale. That's an opening sale, closed out with a closing purchase or buy to close. So if they buy 1,000 shares of CDT, they will use that to replace the shares that they borrowed, so they don't owe anything anymore. But if they can replace it at a lower price, they get to keep the difference. Now you could make the case that maybe that buy 10 CDT calls. Now you can hedge a short position by buying call options because it gives you the right to buy the stock at a fixed price, right? 10 contracts would cover 1,000 shares. Okay, but they can use that as more like a hedge than actually to close the position itself. I mean, they could exercise the call, but then they're just buying the CDT shares anyway. So buy 1,000 shares. Having already sold, now remember their opening sale would have been to sell 1,000 shares of CDT, but that's the one they already did. Right? They've already opened it up. Okay, so now they're going to close it out with a buy. Okay. Tell me, Amy, if that's any part that's not clear. Please let me know, okay? All right, Alicia moves up a couple spaces. Colby's on the board. Let's check the next one. The trade that will be placed in the discretionary account if the registered representative chooses which of the following. 1, the time of execution of the trade. 2, which security to buy. 3, how much of the security to buy. 4, at what price to execute the trade. A, 2 and 4. B, 2 and 3. C, 1 and 2. Or D, 1 and 4. These are right. Okay. All right. Hi, Kimberly. I didn't already read it.
Hi, sorry for being late.
All right. As long as you're here. Okay. Hello, Janae. Okay.
Hey.
All right. The pin is still on the screen. Okay. So this being a discretionary account. Remember, discretion, the customer allows the reg rep to make trading decisions, including which security to buy or how much of the security to buy. So in fact, 2 and 3 would be the best choice. Okay. 2 and 4, remember the price. Remember, price and time is not considered discretionary. If the customer allows their rep to use their judgment when the price is right, not considered discretionary, does not need to be in writing. Okay. So, okay, let's see who's in. Okay, actually moving way up. All right, let's see, next one. Which of the following transactions has the most risk? A, selling short. B, short against the box. C, buying to open. D, selling to close. Selling short has the most risk, exactly, right? It's like we said, when you sell a stock short, you profit if the stock goes down, but you lose if the stock goes up. And there's no limit how high a price of a stock can go, so they have conceivably unlimited risk. Buying to open, well, you can't lose more than the amount of your investment, right? If you buy an investment, okay, all right, it goes right, it goes down to zero, but you can't lose more than that. Selling to close means it gets you out of a transaction, so that eliminates the risk. Short against the box, that's when someone sells a stock short of a stock that they already own. That actually freezes the risk because if the stock goes up, they lose money on the short sale, but they make money on the stock that they own, and they cancel each other out. If the stock goes down, they lose on what they own, but they gain on what they sold short. So basically, it kind of freezes. And it's done basically to lock in the price now. They call it short against the box because people would usually keep their stock certificates in a safe deposit box.
I don't understand how you can short sell a stock you already own.
Oh, no, well, okay, that you already own the stock, right? And then you can also sell the stock short. So you place an order to sell the stock short. So you owe it and own it at the same time. Now they call it short against the box because they figure sooner or later they'll deliver the paper certificate in their safety deposit box. Bring that in and use that to replace what they bought. People used to do that, by the way, to kind of defray their taxes. Okay, because they would do it in December and then close out this position in January. So they defray any capital gains until the following year. But no, they've closed that loophole. Can't do that anymore. Again, does that help answer your question? And if it doesn't, let me know.
Yes, thank you.
Sure. An investor with no existing positions in MMS stock sells 100 shares. This is A, a short bullish position, B, a long bullish position, C, a long bearish position, D, a short bearish position. Bearish position. They don't have MMS stock now and sell it short. So they sell 100 shares. Since they don't have it, there must be selling short. Okay, and of course, a short sale is a bearish strategy, right? It profits if the stock goes down. Good. When you buy a stock, of course, then you own it. That's being long, and that would be a bullish position. If you buy the stock, that's long bullish. There is no short bullish or long bearish. Ashley's 3 in a row. All right, Karina maintains the lead. Let's next one. Selling long is equivalent to which of the following? A, selling to close. B, selling short. C, selling to open then buying to close. Or D, selling to open. All right, well, there's a little split here between A and C, but yes, selling to close is selling long. Remember, long means you own something, right? Long means own, short means owe. And selling long means selling something you have, which of course would be closing out your long position, selling to close. Good. Okay, selling short, no, that of course is the opposite. And selling to open, that would also be selling short. Good. Selling to open, then buying to close, well, not quite the same thing. No, it's just, that would be like just turning around and closing out the, sell it short, buy it back again. I close in the position, but that's only one trade. All right, so getting some coins on. Which of the following transactions has the least risk? A, selling to open. B, selling short. C, short against the box. Or D, buying to open. This one out, but yeah, the one that has the least risk is short, selling short against the box. Now remember, that means someone owns the stock and then they sell the stock short too, which actually cancels out the risk. They're basically doing that to lock in their price. Let's say lock in their sell price. So if the stock goes up, they'll make money on the long position, but they lose money on the short position. If the stock goes down, they'll lose money on the long position, but making money on the short position, and they just cancel each other out. So it really just zeroes everything out. So that really eliminates the risk. Next one. Selling shares not yet borrowed or located to be borrowed is A, known as closing a short sale with a purchase. B, closing a position with a sale and is prohibited. C, known as the short sale and is prohibited. D is known as the naked short sale and is prohibited. Very good. Yes. Selling shares not yet borrowed or located. That's a naked short sale. That is a violation. That is not something that's okay. Regulation SHO or regulation show says to sell a stock short, they must borrow the shares or locate them, find them to be borrowed. And if they cannot find them to be borrowed, they'll just basically cancel out a short sale. So yeah, firms have called the stock loan department. I don't think you need to know that for the test, but that's how it works. So they borrow the shares from other customers at the firm, or they can borrow them from other firms too if they got a customer who has a long position in a margin account. All right, Hannah moving up. Let's check our next one. Your customer owns a position at 45 and then closes it later at 47. This represents A, a 47-point gain, B, a 2-point gain, C, a 2-point loss, D, a 2-point gain or loss. Yes, a 2-point gain or loss. I know, we might have been tempted to think, openly, right, if you bought it at 45 and sold it at 47, that would be a 2-point gain. But it didn't say someone bought to open and then sold to close, did it? It's just an opening position and closed at 47. If they sold it short, for example, at 45 and bought to close at 47, that would have been a 2-point loss, not a gain. It didn't say specifically, so in fact, it could have been a gain or loss. That's just the whole thing, right? Make sure you're paying attention to detail because they're trying to catch you off guard. All right. Alicia was got that one. Nicely done. Yes, Colby.
Hi, I'm sorry. You just gave an example of how it could have been a loss. Could you please give an example of how that could have been a gain?
Well, had they bought at 45 and sold at 47, right? Buy to open at 45, sell to close at 47, that would have been a 2-point gain, right? But remember, it just said opening or closing transaction. It didn't say it was an opening buy or sell. Had it been a sell to open at 45 and buy to close at 47, that would have been a 2-point loss.
Thank you.
Sure thing. An investor who has a short position in 500 shares of JKH common stock would eliminate the position by A, entering a closing purchase order for 500 shares of JKH. B, entering a closing sale order for 500 shares of JJ. C, entering a closing purchase order for 500 shares of ABC. Or D, entering a closing purchase order for 500 shares of JKH. Difference of opinion again, but if they had a short position in JKH, right, that would have been an opening sale. They didn't have the stock and they sold it. That's an opening transaction. And how do you get out of an opening sale? With a closing purchase, by buying JKH back again. All right, no, it wouldn't have been the choice B, a closing sale. First off, they already sold it, so they can only close it. A closing sale has to be preceded by an opening purchase. And besides which, that was a different ticker symbol. JJK, not JKH. All right, nobody guessed ABC, and that's a good one. Okay, good. All right, and an opening purchase, remember, an opening transaction is their first transaction. They already had an opening sale, get out of it by a closing purchase. Good, Colby and Hannah make some points. Let's go to our next one. All the following are bullish positions except A, long calls, B, long stock, C, short stock, D, long holds. The question says, oh, if it's short, you also have to buy it. Trying to trick you. All right, all are following are bullish except, right? That means there's 3 truths and a lie where we have to find the one that's bearish, and selling a stock short is a bearish transaction. Long means to own, right? Those are bullish positions when you expect it to go up. Okay. Well, I think that closes it. Let's see who's on the board. The podium. In 3rd place, bronze medalist is Karina. In 2nd place, silver medalist is Colby. And 1st place, gold medal and Olympic champion, Ashley. Okay, so cheers and applause all the way around. right, let me go pause the video. Okay, let's go back to our next section here. Our section is now on primary market. Primary market refers to the creation and sale of newly created securities, right? They all got to come from somewhere. So how are securities created? How are they registered with federal and state authorities? And what is the action that goes in? How are they sold to investors? And what about the registration? What are the regulations that are behind the securities industry? Well, the first of the major regulations, on the federal level, there really wasn't much in the way of meaningful securities regulations until the Securities Act of 1933. Otherwise, it was very much a buyer beware kind of atmosphere. And people were trading these securities on, have you ever heard this phrase, they bought swampland in Florida or something? That kind of thing. So they'd be trading these securities on these phantom companies, things that didn't really have any real value to it. Okay. But in the roaring 20s, they didn't care because everyone was making money hand over fist, right? Well, you can probably tell by the date what one event in history do you think may have spurred the creation of the Securities Act of 1933? Maybe something happened, just a few years before that. Anyone got a guess? Crash? What crash? Emily? Stock market crash. Great Depression. Right. It was the market crash of 1929. Yes, that basically started the Great Depression. When people were starting to realize that they were purchasing securities that had no value to them, they're really just worthless. Well, no one's going to trust in what they see anymore or what they hear, right? And if nobody trusts, then nobody's going to invest. And if nobody invests, nothing's going to happen. So they needed to restore trust back into the system. So that spurred the creation of the Securities Act of 1933. This is the first major regulation, and it governs the first time issue of new securities, the primary market. So the role here, right, is to basically, the purpose here is to protect investors from fraud. And to protect investors from fraud, they have to know who's out there. So one of the main purposes of the Securities Act is that securities need to be registered. If they're going to be sold to the public, they need to be registered with the SEC, unless there's an exemption from registration. So to do so requires, paperwork. There's always paperwork. So the first step is file a registration statement. Now the registration statement, by the way, the standardized statement is called Form S1. All right, I'm not sure how likely that's going to appear on the test. I don't think it's too likely, but hey, you never know. So that's the standardized form, and the form is going to give to regulators everything they need to know about this company's business, right? Full and fair disclosure of all material facts. Now, this is just a sample of what has to be included: the company's business, the company's management, including a biography of the officers, directors, and executives. How the security will be offered. How are they offering it to investors? What would they plan to do with the money once they've raised it? The company's financials, right? Its balance sheet, its cash flow statements, all have to be known, and a whole lot of other stuff besides. So this registration process is a very difficult, expensive, and time-consuming affair. It'll take a long time and cost a lot of money because they have to have everything right for the regulators, and they'll hire securities attorneys. All right, so now a firm will typically use an investment banker, also known as an underwriter. Let me write that word out for you here too. Okay, so the role here of the underwriter or investment banker is first help the issuer get their securities registered with the SEC, right? Also guide them and consult with them on how to put together an offer that would attract investors, and then go out and do the marketing, right? Get out the phone, right? Get the word out, get a buzz going, make a market for the issuer's new securities. So typically what will happen in an offering, in an underwriting, the underwriter, also called the investment banker, will purchase all the securities from the issuer. Just buy them all up from lock, stock, and barrel. Well, what if it's like they're raising $1 billion? Well, they'll give them $1 billion. They'll buy all their securities from them and then turn around and sell those securities to their customers at a higher price, a slightly higher price. So that slightly higher price is known as the public offering price. That's the price that's going to be in the prospectus and the price at which ground floor investors can purchase. The difference between what the issuer gets, the company gets, and the public offering price, that's known as the underwriter's spread. And the spread is basically the commission for going out and selling these things and And also remember that when they purchase all these securities, they give them like $1 billion with the idea that they'll buy all their securities from them, turn around and sell them to their customers at a higher price. Well, there's some risk in that. What if people aren't interested? Well, if they don't want to buy it, they may be stuck with merchandise that they can't move. Okay, so first off, the purpose of the Securities Act, one, publicly disclose all information. Full and fair disclosure of all material facts. That means the good, the bad, and the ugly. Everything's got to be known. And of course, also makes it unlawful to commit fraud in the connection with the offer or sale of new securities. Before they can be sold to the public, they have to be cleared and registered with the SEC, right? And they have to go through the process of registering those securities. And until it's considered registered with the SEC, they're not available for sale. Question is, what's the spread formula? It's what they sold it for minus what they paid for it. Let's say, for example, in a new public offering, ground floor investors buy at $20. Okay, so that'd be the price in the prospectus. If you're able to get on the ground floor, $20 a share. Out of that 20, maybe 19 goes to the company, to the issuer, and they'll use that to build and grow and expand their business. What is the other dollar? That's the spread to the underwriter. That's what they make their money for marketing, for consulting, and for pounding the pavement and selling these things. Question is, are these IPOs? Yes, they are. Yes, IPO is initial public offering. That's the very first time that securities are being sold to investors. Initial public offering, right? Being sold to the public. Okay, there can be only one initial public offering, but companies sometimes they want to sell more shares. That would be called an additional public offering or a follow-on offering. There can be any number of those. But yes, otherwise, Kimberly, yes, this is an IPO. Okay. Now, some securities, however, are exempt from registration because of their nature. By regulation, they never require registration. Keep in mind the purpose is to protect investors from fraud, so they have to know who's out there. Well, anything that's government issued is exempt from registering. We already know who the government is. Whether they're federal government like Treasury bonds, government agencies like GNMA, municipalities, state and local governments, and foreign government debt. So maybe I should say recognize foreign governments. Recognize means that the U.S. has diplomatic relations. Another word for that, by the way, is sovereign debt. Sovereign debt. Okay. So if it's government issued, it's already exempt from registration. Some securities are exempt, or at least the certain industries are exempt because of the nature of their business. Securities that are issued by banks, savings institutions, and trust companies are exempt. Securities issued by, but not, let me make this clear here, bank, but not bank holding companies. A holding company is a corporation that owns financial institutions. Like Wells Fargo is a holding company that owns Wells Fargo Bank and Wells Fargo Securities and Wells Fargo Advisors and probably a dozen Wells Fargo subsidiaries. Securities issued by Wells Fargo, the bank, are exempt. Securities issued by Wells Fargo, the holding company or the parent company, not exempt. Watch for that. I have sometimes seen practice questions that said bank holding company to make sure you're paying attention to detail. All right, securities issued by insurance companies are exempt, stocks or bonds from insurance companies, but not variable contracts like variable life insurance or variable annuities because those are effectively mutual funds. So they have to register like any other mutual fund. Securities issued by common carriers. That's the word they use in the legislation. When they say common carrier, think railroad, or by extension in the business of transporting people or cargo. There's another one here. It's not on the slide, and that is public utilities, like the electric company and the oil and the gas company, for example. They ever say, why do these industries, why do they get a pass on it when nobody else does? Well, it's because those industries are already heavily regulated and they already have regulatory oversight. So since they have to answer to somebody, they get an exemption from registration. Basically, other regulations apply. Securities issued by nonprofit organizations, education, charities. Sisters of Mercy, for example, wants to build a hospital and does a bond offering. Okay, so they're a registered charity, exempt from the securities are exempt. Money market securities, that would mean specifically commercial paper, which are short-term corporate bonds. A short-term means 270 days or less, but it's frequently less, often a lot less, like 30 or 60 days, when they need short-term or interim financing. And bankers' acceptances. Those are issued by banks, and those are used to finance foreign trade or import-export. So when you see it on the test, like import-export, that's almost a key word there for bankers' acceptances. Small business investment companies, they're basically they basically like incubate small businesses. You ever heard of like Y Combinator, for example? Right? They take in small businesses, they provide them consulting, give them some financing to get them up off the ground. All right, so those are exempt. Exempt means they are not required to register by regulation and by statute. So a non-exempt security, well, that one means that they are not exempt from registering, and the regulations do apply. Anything corporate, for example, with those exceptions we mentioned, are going to be non-exempt. So our options, which are basically call and put options, investment companies, mutual funds, and limited partnership shares, they also require registering with the SEC. Now, there are also a list of exempt transactions. Now, these are for securities that by themselves are not automatically exempt because of what they are, but they can still be sold to investors because of how it's done, the way they're selling it. One of those exemptions is called Regulation A of the Securities Act of 1933. So under Reg A gets an exemption for small offerings. How small is small? Well, there's actually a couple of different tiers on them. Tier 1 is up to $20 million. Tier 2 is $75 million. And there's a different, maybe different requirements for them. But it could be as small as low as $75 million. I say, that's small? Well, in the scheme of things, it is, right? Because instead of like multi-billion-dollar offerings. All right, they are open to U.S. and Canadian companies, right? But not to investment companies, which means mutual funds, or disqualified issuers. For some reason, they don't meet the requirements, or they did something they shouldn't have done. Because they're exempt from registering with the SEC, they're also exempt from a prospectus delivery requirement. Remember, a prospectus is the disclosure document. It's a legal document that tells any potential investor everything that they need to know, good, bad, and ugly. Okay? Well, they don't have a prospectus as such. Instead, it's an offering statement or offering circular, which does the job that a prospectus does in providing full disclosure to potential investors. All right, now, under Regulation A, once they deliver their registration statement and give it to the SEC, under this exemption, they still have a waiting period of minimum 20 days. That's during the time where the SEC is reviewing the registration statement. And it could take longer if necessary before it's declared effective by the SEC. Now, during this waiting period, now again, you'll see this just like regular stock offerings, but they can do a preliminary version of the offering circular just to kind of see, well, who might be interested, kind of test the waters to find out if investors might be interested or not so much. Okay, now once it's declared effective with the SEC, that means the SEC has cleared it for sale. Now you can start selling it. Now there's a final version of the offering circular to give to any potential investors. Another exemption is under Rule 147. Sorry, question? No, all good? Okay. In Rule 147 allows an intrastate exemption, which means they're only going to take investors from inside their own state. Since they're going to do investors from one state only, they don't have to do a federal registration with the SEC. They'll still register with the state, just not federal. To qualify, there has to be meet one of these three things, okay? You call it 80-80-80. Either 80% of the company's revenue has to come from in that state, or 80% of the assets the business has to be within that state, or 80% of the money they're using to raise capital has to be used within that state. And all of the shares that are sold have to be to residents of the state, not outside the state. Okay. Also, the issuer has to have his principal place of business in that state. The majority of people employed, its employees, must live in that state. And if they're sold under this exemption of Rule 147, since they were not SEC registered, they cannot be sold outside the state for 6 months. Once the 6 months are up, then they can sell it outside the state. Regulation D of the Securities Act allows for an exemption for a private placement. That means they're exempt from registering because they're not going to sell these securities to the public. Not just anybody can get in. So you got to know someone who knows someone. It's a private deal. So therefore, they're not being offered to the public. Get an exemption from registration. Now, there are some limits as to who can invest in a private placement, and they're limited mainly to accredited investors. Accredited means they meet certain financial conditions, but they can have up to 35 non-accredited investors, 35 regular folks per deal, but the number is limited to 35. That's meant to be kind of a friends and family kind of thing for the founders of the company to get friends and family onto it. Limited to 35. They have to complete a accredited investor questionnaire in which they attest as to their financial conditions. And again, since they're exempt from registration, they don't have to have a prospectus delivery requirement. Instead, their disclosure document is called a offering memorandum or private placement memorandum, which again does the job of providing full and fair disclosure of all material facts. I mean, why do they do that if they're not required to deliver a prospectus? It's because investors want to see one anyway. Right? Investors want to know, and so because they have to consider this investment. So, who is an accredited investor? One, it's going to be an individual with $1 million net worth, excluding primary residence. So we can't use their home equity to see if they meet this $1 million net worth. Excuse me. If not $1 million net worth, it's also could be someone who has an annual income of $200,000 a year for at least the last 2 years and expects to continue to do so, or if married filing jointly, would be a joint income of $300,000 for the past 2 years. Those two conditions, those are most of the main criteria to be considered accredited. Now, it also counts as someone who's an officer or director of the issuer, right? An executive of the company. I mean, they should be familiar enough with their own company to be able to invest in it in a private placement. It also includes financial institutions, right, with at least $5 million to invest, or nonprofit institutions, okay, like with at least $5 million in assets. I thought I saw somebody's virtual hand go up. Okay. Okay. All right. Difference between a prospectus and a memorandum. All right. A prospectus is a legal document that has to for non-exempt securities that have to register with the SEC. They must deliver a prospectus as a disclosure document to tell any potential investor everything they need to know. The memorandums, like the private placement memorandum, right there, since they're exempt from registering with the SEC, they're also exempt from a prospectus delivery requirement. They don't have a prospectus. Instead, it's a offering memorandum, offering circular, private placement memorandum. Is there any other difference between that? Not really. It's still, again, to do the job of full and fair disclosure of all material facts. Just know prospectus is specifically for securities registering with the SEC. Okay. All right. Now, there are actually different rules under Regulation D with different ones. To tell you the truth, though, I'm not going to bother about these different Rule 504 or 506. Just this, okay? Securities that are sold under Regulation D are to accredited investors only with up to 35 regular folks, right, in per deal. Okay. That's the real thing we need to know. I'm not going to get any deeper than that. Okay. All right. Before we go on talk about the underwriting of a primary offering, we're close enough, I think, to the top of the hour. So let's go ahead and take a little quick break here. So let's break for 10 minutes and return at 8 minutes past the hour, whatever that hour is for you. Sorry, I say that so many times because I often talk to people all over the country. So this time I'm remembering everybody's here locally. So, all right. Could I repeat it one more time about Reg D? Okay, Regulation D is an exemption, right? It's an exempt transaction. The securities are not automatically exempt, right? They're corporate securities. It's the way they're being sold. They can still sell them without having to register with the SEC. It falls under an exempt transaction. An exempt security is a noun. An exempt transaction is a verb. And because it's a private deal, not offered to the public, it gets this exemption from registration. But, okay, it is limited to mainly to accredited investors who meet certain financial conditions. Oh, I forgot something about a definition of accredited investor. Because this is new. This is only within the last couple of years. anyone with an active Series 7, Series 63, or I think it's the Series 82 license. I'm trying to remember if it's 82 or 83. Right? But if they have an active license on it, they're also considered accredited. So guess what? You're about to become accredited investors. Congratulations. I never got to be an accredited investor. Good job. Something you can do something I never could. Okay, but you just wait till I hit that $1 million net worth. Okay, then we're talking. All right, so we'll talk about the underwriting here in a moment. Thanks, Kimberly. All right, when I see you here in just a few minutes. Okay, see you soon. Okay, we'll set a timer for 8 minutes.
All right, 8 minutes. Starting now.
Okay, let's get rid of that here. Let's welcome back from break. Okay, now let's talk about the underwriting process. Okay, so a company wants to go public, right? They want to raise capital to build, grow, and expand the business. So the very first time that securities are being sold, primary market, remember that's the initial sale of newly created securities, is known as an initial public offering or IPO. All right, there can only be one initial public offering, but it is available to the public, right? Not just to the industry, not just to insiders, but to the public. Once the shares are registered with the SEC, then they can be traded in between investors. That's the secondary market. So primary market is from the sale of from the issuer, like a corporation or a government, selling securities to investors. And who gets the money from the sale in a primary market transaction? It's the issuer. It's that corporation to build to get the capital they need to grow and expand the business. In the secondary market, which is trading between investors, who gets the money from the sale? Another investor, somebody besides the issuer. I think of the secondary market kind of like secondhand securities. Now, sometimes the company's done an initial public offering, they've sold shares to investors, then they want to sell more shares to raise more capital. That's known as a follow-on offering, which I've also seen called an additional public offering, right? Or an APO. There can only be one IPO, but there can be any number of follow-on or APOs. Good. All right, now a secondary offer, okay, primary offering, the issuer sells to the public. In a secondary offering, this is when one of the large shareholders, maybe an executive of the company, maybe some of the venture capitalists who put the seed capital into it, their whole exit plan was to take the company public and then they sell their shares. In fact, they'll often do it during the initial public offering. They sell their shares and that's was their whole whole plan on how they were going to make their money. So in the secondary offering, it can often go on while the initial public offering is happening. In fact, when they're doing it at the same time, it's known as a combination or split offering. So the shares from the issuer, as well as some of those large shareholders, they're selling their shares at the same time. Companies that have been established and already known to the SEC may want to, again, offer additional securities or new securities. Maybe it's a bond offering, for example. But they may not need money right away, but they want to get the whole underwriting process underway, right? The whole registration process, because it is difficult, it's time consuming, and it takes a while. So they may want to sell the shares registered, but sell them at a later date or maybe over a period of time. They call that a shelf offering because they're going to register securities with the SEC, get the whole registration process done, and then they put them on a shelf. Could be for as much as 2 years. And if you're already well-known seasoned issuers, right, very well known to the SEC, that could be as much as 3 years. So that lets them do their registration early and then sell the ridiculous shares later. And all they have to do is give notice to the SEC once they're ready to sell. Okay. So a company needs the help of an underwriter, right? That's a broker-dealer firm, but specifically one that's going to take on the responsibility and role of helping the issuer get their securities registered with the SEC, put together an offer to attract investors, and then go out and get the word out, get a buzz going, get the people on the phone, smile and dial and say, I got a hot deal for you. Okay. So the investment banker or the underwriter helps them through registration and then helps them sell the securities. There are two main ways of doing an underwriting, a negotiated or a competitive bid. Now, you'll see these terms particularly for municipal securities, right, for state and local governments. They'll typically do either negotiated underwritings, where they basically have already picked the firm they want to use as their underwriting firm, and then they just negotiate the deal between them, right, and negotiate the offer. Okay. A competitive bid, that's more likely to be done again for municipalities, especially because for general obligation bonds, which are paid by taxes. So, since they're paid by taxes, they want to ensure that they'll put out a request for proposal, put out a sealed bid, right? Anyone who wants to put in a sealed bid, and the one with the lowest cost to the issuer, okay, lowest bid wins basically, or lowest interest cost to the issuer wins the bid. There are two real types of commitments that a firm can make, that an underwriter can make with an issuer, with a company. All right, there's firm commitment or there's best efforts underwriting. Now, in a firm commitment underwriting, which is the most common type, the underwriter plus the syndicate they put together purchase all the securities from the issuer. Well, if they wanted to raise $1 billion, they give them $1 billion and buy all their securities from them, lock, stock, and barrel. Then the underwriter then turns around and sells their shares, the ones that they bought, to their customers at a slightly higher price, right? Making the spread in between them. Now, of course, a company, an issuer, would like to have a firm commitment underwriting. That way they know they'll sell the securities and they'll get the money they need to raise, right? Get the capital they need. So they'll pick an underwriter that agrees to do one. The underwriter here has purchased all these securities, and now the underwriter has risk here because they've just got a whole bunch of securities, right, items in their inventory, and they've got to move the merchandise. What if it turns out investors aren't interested? What if the market crashes and now nobody wants to take any chances? Well, they may be stuck, right, with merchandise and inventory that they couldn't sell. They could be liable for the unsold shares, basically stuck with them. Maybe they can sell them later on, but they're still kind of stuck. All right. In a firm, so yes, the underwriter here has a great degree of risk in a firm commitment underwriting. They act as a principal transaction, right, or as a dealer in the transaction, as buying at one price and selling at a different price for profit or loss in and out of their own inventory. Now, the other one is called a best efforts. In a best efforts underwriting, the underwriter will do their very level best to sell the issuer securities, but with no guarantees about what they'll be able to sell, or even anything, or even everything, or even anything, right? Maybe nobody's interested. So they'll make a best efforts underwriting. They'll make their honest best chance they get to sell the issuer securities, but with no guarantee. Any securities that are left over that they could not sell get returned to the issuer. Give it back to them. Sort of sounds like consignment sales, doesn't it? Now the issuer, right, this company says, well, we need to raise a certain amount of capital, and if we can't raise the money we need, there's just no point in doing this. So they could make it an all or none best efforts. In an all or none best efforts, the underwriter must sell all the securities, everything, and sell all the securities out, raise all the capital they need. And if they cannot sell all of them, they're just going to cancel the offer. They'll cancel the issue. So they'll basically just give it back to them. Anyone who did invest gets their money returned to them. So that's why they have to have an escrow account to hold money for people who have invested, pending the successful completion of the underwriting. They can also do it as a mini-max offering, where the underwriter must sell at least a minimum amount of shares, right? Raise a minimum amount of capital up to the maximum. But if they couldn't raise at least the minimum, they're just not going to go through with it. They'll cancel the offer. Anyone who did invest gets their money back. Okay, so in this case, at a best efforts basis, the firm acts as an agent or a broker capacity, right? Matching up buyer and seller and having no liability for them. Right, so that's the case here. All right, so the underwriter is called, well, the one who got the deal with the issuer, they'd be known as the lead or managing underwriter. But to help them spread out the risk, as well as to help them spread the word and get the securities offered, they'll often form a syndicate. So they'll invite other broker-dealers firms to participate and purchase some of the securities from the issuer as well. Everyone will agree to take a certain amount, and they'll turn around and sell it to their customers, again, for a higher price. I think somebody raised a hand a moment ago. Did anybody? Heard a little ding, so. Okay. Difference between principal and agent. As a principal in the transaction, they're actually part of the trade, acting in a dealer capacity. A dealer, like if you go to a car dealer, they'll buy it from you at one price and sell it to you at a different price, right? Makes the difference on the prices in between. That's how they make their money. An agent is somebody who basically works on, represents someone else, acting on someone else's behalf, acting as a middleman in the transaction, finding someone who wants to sell, finding up with someone who wants to buy, and facilitate a transaction between them. Okay? A dealer, of course, has a great degree of risk involved. They've purchased securities in inventory. They've got to be able to sell it again for more than they paid for it, and maybe they can't. Agents, however, have virtually zero risk because they don't have their own capital in place. They're simply matching up buyer and seller. Does that help answer your question? All right, Karina, thanks. Okay, so the underwriter, buy the securities from the issuer at one price and sells it to their customers at a slightly higher price, and the difference between those two prices is known as the spread. The public offering price, that's the price in the prospectus that tells you what ground floor investors are able to buy it per share. So the difference again between them, that's the compensation for that's what the underwriter gets, right? For going out, selling these things and forming selling groups too. Now, out of that spread, it basically breaks down to other parts. So let's say the public offering price is $20. Okay, so the public offering price is $20, okay, but the issuer gets $19 out of the 20. So therefore, the syndicate or the underwriting syndicate gets the $1 spread. Now, out of that $1 per share spread, that gets broken down too. The management fee is for the lead underwriter, right? So that's what they get for putting the whole deal together and for doing all the management and getting everything all set up and everything, overseeing everybody. So the managing underwriter always gets the management fee, right? Regardless of how it's sold, it's basically like a sales manager's override. So maybe out of that $1, maybe the management fee is like 20 cents. So every share that's sold, right, the lead underwriter gets 20 cents out of it. Okay, now the members of the syndicate, right, who also have purchased securities from the issuer, right, on a principal basis, turn around and sell it for their customers too. Now, out of that, they get their underwriting fee. So for every share that they sell, maybe they get 30 cents out of that every dollar, okay, as their underwriting fee. Okay, which also includes, right, the risk that they take for having done the underwriting and in a firm commitment underwriting. So they got to cover that cost before they can show a profit. The selling concession is for the members of the selling group. Okay, so the selling group is not part of the syndicate. The syndicate has risk, right? The syndicate purchases securities and sell them to their customers at a higher price, and they have the risk involved in this. They'll often get other broker-dealers, however, to form a selling group. Now, the members of the selling group, they act as an agency basis. They're basically going to be additional salespeople, call their customers, and get people interested in purchasing and investing in these newly issued securities. So for every share they sell, they get maybe 50 cents out of the dollar. So so the selling group, the broker-dealers who act on an agency basis, they get 50 cents out of every dollar. The underwriter that sponsored them, the members of the syndicate that put them into it, they get 30 cents out of that dollar, and the lead or managing underwriter gets 20 cents. When the managing underwriter sells a share, they'll pay themselves the 27% management fee, the 30-cent underwriting fee, and the 50-cent selling concession. So the managing underwriter gets all three. Okay, let me see. I'm trying to figure out a way that I can write that out for you to make it kind of visually clear here. Managing underwriter gets everything. Okay. When they sell, the managing underwriter gets everything here. Okay. The members of the syndicate, when the members of the syndicate sell their shares, they get the 30-cent underwriting fee, right? And also they get the 50-cent selling concession. When members of the selling group, who remember they don't have any skin in the game, right? They're just additional salespeople. So the members of the selling group, they get the selling concession. They get the 50 cents. The syndicate that put them into it gets the 30 cents. The managing underwriter gets the other 20 cents. So that is how they're doing. So the question says example, please. I was hoping to come up with an example. I was trying to give you one here. Okay, but Merrill Lynch is the lead underwriter. They got the whole deal together, and they're doing the whole management of the whole offering here. So they got some real work here, right? So is when Merrill Lynch's, if they sell a share, they get the $1 spread. They don't split it with anybody else. Now Merrill says, okay, this is a big offer here. We want to get other broker-dealers involved to help spread out the risk and also spread the word. So maybe they'll get Smith Barney and Dean Witter in it as well. Okay, so they'll form the syndicate. So Smith Barney, Dean Witter, they'll purchase some of the securities from the issuer too, and they have risk involved here. But when the members of the syndicate here, Smith, Barney, Dean, Witter, when they sell, they get 80 cents for every share that they sell, and Merrill Lynch gets the other 20 cents as their override. All right, now Dean Witter says, okay, we need some help here too, so we'll get a company in like Edward Jones, okay, to act as a part of the selling group here. So they'll sell some of the shares, but Edward Jones is not purchasing any securities themselves. They're just going to sell as many shares as they can on an agency basis. They don't have any risk or skin in the game. So every time Edward Jones sells a stock, they'll get 50 cents out of the $1 spread. Dean Witter, who kind of got them into it, gets the 30 cents as their underwriting fee, and Merrill Lynch gets the remaining 20 cents as their manager's override. Kimberly, I hope that helped.
It does. So does the syndicate, do they hold shares? You said the selling group won't hold shares.
Correct. The syndicate does, yes. The syndicate holds.
So where does the selling group get their shares from? Do they get them from the syndicate?
They get it from the underwriter. They get it from the underwriter. From the syndicate, yes.
Okay.
Yes.
And then the syndicate gets theirs from the managing.
Yeah, yes. So that's how the money goes round.
Thank you.
Oh, my pleasure. You bet. Oh, here we go. Here's an illustration. That'll help. Okay. All right. So $20 a share. Okay. I was saying $19 was it? All right. $19.50 goes to the issuer. And that's how they raise the capital to go and build their business and build a factory or hire a bunch of people or a fleet of trucks, whatever they need to build their business. All right. So the other 50 cents is the underwriter's spread. Out of that 50 cents, 10 cents is the manager's fee. So the managing underwriter gets 10 cents for every share sold, no matter who sells it. The underwriting fee is 15 cents out of that 50 cents. So the members of the underwriting syndicate, so remember, since they put their money into this, they purchase securities and have that risk capital, they've got to cover that capital before they can show a profit. And the seller, so they would make the underwriting fee plus the sell concession for every share that the syndicate sells, but they'll get other companies in to be on the selling group, The selling group does not purchase any shares. They're just additional salespeople on an agency basis. They'll make 25 cents out of every share for every share that they sell. All right, now there was an illustration, okay, rather than just my trying to stack letters one on top of the other. Okay, the registration process. Now, this is a difficult, time-consuming process. Right, so the first step is the pre-filing or pre-registration period. This is where the issuer wants to go public, wants to sell securities to investors. They'll find an underwriter to help them do so and help them to create the registration statement, Form S1, which goes to the SEC, which will include everything that regulators need to know. All right. Now, you may have ever seen a prospectus, and the prospectus will be inclusive of Form S1, but the prospectus is like a simplified and easy to read version of what's in a registration statement. Okay. So that part, again, is expensive. It's time consuming. They'll get securities lawyers. This will take a while and cost a lot of money, but eventually they'll fill out their registration statement. Okay. Once they do, then step one, the first phase is over, the pre-registration. Phase two then starts, which is the filing the registration on Form S1. There's another one called S3. Okay, that I doubt they'll ever come out to that one. But anyway, it will contain everything investors need to know, including the preliminary prospectus. The preliminary prospectus is to be replaced later on with a final prospectus, but does indicate that this is the information that investors need to know, except for a couple of things. Once they file their registration statement with the SEC, now the issuer has a filing date, right? That's the date they rubber stamp their paperwork at the SEC to indicate that their form has been filed. Then starts the cooling off period. Now, the cooling off period, I've also heard called the quiet period. I'll mention that just in case here. Okay, so this is the period of time where during this period of time, the SEC will review the registration statement. This will be a minimum of 20 days, can be longer if necessary, and fact is it will probably be longer, maybe even considerably longer. During this time, the SEC reviews the registration statement. Now, one thing to keep in mind, the SEC does not approve the registration statement. Regulators do not approve anything because the word approve carries a connotation of an endorsement. No regulator will ever do that. So you'll just hear them use very neutral language, like they grant effectiveness of registration. Now, the SEC is reviewing this. Now, keep in mind, during this time, they do not check to see if the information in the prospectus is true or false. They do not verify or vet the information. They're just looking to see that everything appears to be complete and does not appear to be misleading. Once they grant effectiveness, they're basically saying we just don't see anything illegal here. So they're not going to give any kind of endorsement or anything like that. If, however, they find a problem with the registration statement, they will issue a deficiency letter. Let me write that out there because it's not on the slide. Deficiency letter, which means we see a problem with your registration statement and tell them what needs to be corrected. Okay, so then, once they send this deficiency letter, it's like pressing a button on a stopwatch. All right, the 20-day countdown stops until the deficiency is corrected. Right, they file an amendment. Once they file it back with the SEC, it's like pushing a button on the stopwatch again, and the 20-day countdown resumes. Question is, who verifies if it's true or false? And the answer is nobody. Nobody verifies if it's true or false. Now, if it does end up being false information, all right, and investors find out about it, yeah, there can be some serious lawsuits about it. Okay, right? The lawyers are going to sharpen their teeth, right? If there's material fraud inside the registration statement or inside the prospectus or the preliminary prospectus. Okay, but no one verifies true or false. Okay. Now, by the way, if the issuer decides that they need to amend their registration statement, it says, oh, we found something we should have included, or something, they have to correct the mistake, they will update, amend their registration statement. But in this case, the 20-day countdown starts over. Now, during this cooling off period, now remember, they call it that because, there may be some buzz already on the street, on Wall Street, to say, hey, this is who's going public here and wants to sell shares to investors. So they got to give them some cooling down time, right, to get so that people can calm down and give them the chance to review this information. Now, during this period, they are not allowed to sell these securities. They are not allowed to offer them for sale or advertise them as being for sale. The only thing they can do now is get indications of interest. That means find out from their customers who might be interested in investing once it does become available. Okay, and these are non-binding, by the way, indications, which means that if people want to change their minds later, they can. But they will get the preliminary prospectus along with this to help investors decide, is this something they'd want to invest in? Now, the preliminary prospectus is also known as a red herring prospectus, and that's because it says on the front cover in red ink that this is not an offer for securities, that the registration is not effective with the SEC, and this preliminary prospectus will be replaced with a final prospectus. Okay, I want to see. No, it doesn't seem to mention here. So what things are in the preliminary prospectus is just about everything someone needs to know to make informed decisions, right? Full and fair disclosure of all material facts. It will not have the effective date, because it's not effective with the SEC yet, and will not have a final price. At this point, they only will have a price range, somewhere between here and there. And based on the levels of the indication of interest they get, they'll use that to determine if the final price will be at the lower end or higher end of that range. All right. Okay, now I said they're not allowed to advertise it for being for sale, with the exception of what's called a tombstone ad. And if you've ever seen one, like in the back pages of the Wall Street Journal, you'll know why it's called a tombstone ad. It's basically a big white space in the newspaper with a heavy black border and a little bit of words in the middle of it. So seriously, it looks like a tombstone. And this is just bare bones information, right? It's just it's like name, rank, and serial number stuff. At the tombstone ad has to include the disclaimer. This announcement is under no circumstance to be construed as an offer to sell or a solicitation of an offer of these securities. It's only made by prospectus. They have to have a prospectus to make the offer. So what it really is an invitation to look into it to acquire a prospectus. So what is going to be on the tombstone ad? It's basically going to include the name of the issuer, right? The company or municipality or whoever it is that's offering securities, the name, the number and type of securities, like 35 million shares common stock or $20 million in debentures or whatever it's going to be. They'll have a price if there is one, or a price range if that's all they have at that point. It will have also the name, a brief description of the business, what do they do, and the name and logos of the members of the underwriting syndicate. So, which is who to call for more information, and that's just about it. All right, expected ticker symbol and exchange, if they know that at that point. If they're offering bonds, the maturity date of the bond and the interest rate and the yield, which is the return on investment. Okay, because the yield might actually be different than the interest rate. Okay, so that is going to be in a tombstone ad. It's just bare bones information. Okay, and just really an offer to acquire a prospectus. All right, now once the 20-day cooling period is done, hopefully the SEC will now declare the issue effective, and now the post-registration begins. And at this point, they've now cleared securities for sale. The SEC is cleared for sale with the public. They can now sell the securities, and now there's a final IPO. There's a finalized price to also be given in a final prospectus. The final prospectus, also sometimes called the statutory prospectus. Okay, good. So that is the disclosure document. So anything and everything that needs to be known, all material information has to be in the prospectus. Okay, actually, you know what? Before this information is up here, right about the end of the cooling off period, this should be mentioned here, they conduct a due diligence meeting. Okay, so the issuer, the underwriter, the syndicate members, right, and the public, by the way, is invited to the due diligence meeting. And in the meeting, they're going to discover, well, what has the indication of interest been like? And is it worth like it's going to be a hot issue, or maybe not so much? So that's going to happen at the due diligence meeting. And then once it's declared effective, now they can start offering the securities. They'll do the initial public offering, sell the securities to the ground floor investors, right? The ones who are able to get in on the IPO. All right, now remember, not everybody can get in on the IPO, right? If they're only going to sell 35 million shares, that's all there are, right? So who tends to get in on the IPO? Well, it's probably the syndicate members' best customers. Okay, the ones who put up with them and bought the stuff that wasn't so great. Now they give them the chance to buy the stuff. So okay, just sort of an aside, but when I was still working as a rep, one of my coworkers asked me who tends to get in. I said, well, I read something somewhere that, at one of these firms, like if you don't have $5 million on deposit with them, you're not even on the radar because they're not even going to worry about it with you. So my coworker said, so you and I couldn't get in on it. So I said, well, maybe you can't, but okay. So it's pretty few people who can get on the IPO, right? They do tend to give it to their best customers. Here's the thing, though. We'll probably see this in the regulation section. Right, it is initial public offering. It is not available and cannot be purchased by the industry. Broker-dealer firms, associated persons, right, people who work for broker-dealer firms, cannot purchase the IPO at the IPO price. Neither can fiduciaries to the issuer, like their lawyers and accountants, for example, and neither can immediate family of employees of broker-dealer firms. They can't purchase at the IPO price either. Okay, great. Why? Because again, it's a public offering to the public, not to the industry. All right, that covers our section here on the primary market, on the creation and sale of new securities. So once they've been sold to initial or ground floor investors' primary market, then they are traded between investors in the secondary market. The secondary market is governed by the second major regulation, which is the Securities Exchange Act of 1934. So it was a pair of regulations, these sister acts. The Securities Act of 1933, which governs new issued securities in the primary market, the Securities Exchange Act of 1934, which is which governs the secondary market or trading in between investors. So the Securities Act of 1934 basically does a bunch of things, right, in the secondary market. And again, its main purpose is to protect investors from fraud. Now, the Securities Exchange Act authorized the creation of the Securities and Exchange Commission, right, as being the federal body, the federal regulator that would oversee the entire securities industry, and that everyone and everything in the securities industry reports to the SEC. The SEC itself reports to Congress. So who has to report to the SEC? Right? Firms that offer securities for sale to the public, they have to report to the SEC. In fact, they're even called reporting companies. Broker-dealer firms, right? The employees of broker-dealer firms, that's why you're a registered representative, okay? And the stock exchanges also have to register, be registered with the SEC. All right. Now, one of the things that part of the Securities Exchange Act is famously its anti-fraud provisions, right, which basically protects investors by making it unlawful to commit securities fraud, which they say is how do they price is to employ any device, scheme, or artifice to defraud, to make untrue statements of material facts, that means lie, or to omit material facts, or to engage in any activity that would operate as a fraud or deceit on any person. Okay, basically means that to be as an act of fraud means someone has to know the truth and deliberately lie or hide vital information to induce someone to purchase securities. That's why I say material facts, right? Essential need to know information. If it's not a material fact, it's not considered fraud. Okay, it's still unethical, right? Not supposed to lie to people, but it's not a criminal act. Fraud is a crime. Keep in mind that anti-fraud applies to exempt and non-exempt securities. The exemption just means exemption from registering with the SEC. No one and nothing is exempt from committing securities fraud. One of the famous parts, actually, is called the Rule 10b-5, okay, which means that we can't possibly ahead of time think of any type of scheme or scam or that you can come up with. So anything that is considered to be a deceit, right, a willful intention to deceive somebody is going to be securities fraud. If you can think it up and we decide it's fraud, it's fraud. That's what they say that's rule. So it's just like the catch-all rule of the anti-fraud provision. So these include things that are considered prohibited activities, right? Things you cannot do in the trading of securities, such as market manipulation, right? How to deceive investors to buy or sell securities, right? So Things like spreading rumors. Hey, guess who I heard is a takeover target? That kind of thing, right? That kind of market manipulation. Wash trades. A wash trade is when someone buys and sells the same securities. There's no real change of ownership, right? Maybe they have control over different accounts, for example, and just trading from one and the other to make it look as if a security is actually trading more than it really is. Creating trading pools, right? A bunch of people together, right, to manipulate the price. Pump and dumps, pump and dump schemes, right? Placing orders or spreading rumors to try and pump up the price, and then, well, dumping the shares on their unsuspecting victims. Front running, which is sticking your trade in ahead of a customer's trade, especially if it's like a corporate customer going to do a big block trade, one that's big enough to move the market. And think, oh, I know, I'll stick my order in first. I'll put the big giant order in right behind me, let it move the market, then I'll get out. Not allowed. Firm, right, the customer's orders must be fulfilled before the broker dealers or the registered reps orders. All right, painting the tape. That's like the wash sale, like creating false trading volume, except it's a series of transactions between different people, just to trade between each other, again, to make it look as if a stock that hardly gets any activity, right, is all of a sudden moving up on much higher than normal volume. Some of my notices say, hey, something's going on here. I better get in on this. Nothing but a scheme. They're just going to unload their shares on their unsuspecting victims. Painting the tape, right, refers to that bell jar ticker tape. You've seen them in movies, right? That long string of ticker tape paper that under a bell jar. Okay. Pegging, which is attempting to market manipulation to stabilize the price. Okay, to try and keep it from moving up or down. The only type that's legal to try and stabilize the price. In fact, it's called stabilization, and this only is done by the underwriter or the underwriting syndicate. Now, remember, in an initial public offering, very often, right, the public offering price maybe was $20 a share, but if it's a hot issue that everyone's just chomping at the bit to buy, once it starts hitting the secondary market, the price very often does this quantum leap upwards, right? The underwriting price was $20, but the first trade was $50. Okay, in case you're wondering why people salivate when they hear about initial public offerings, okay, that's why, because they hope they can make this huge fortune like immediately. Well, that can happen, but sometimes it doesn't work out that way. Sometimes the price actually drops, right? While the initial public offering is still going on, the secondary market price drops below the public offering price. Now, during the IPO, see, no one's supposed to be able to buy it at a price lower than the public offering price, at least not while the initial public offering is in progress, once they're still selling it to ground floor investors. So if that happens, the underwriter can step in and stabilize the price by putting in a bid to buy it at a price that's at or just below the public offering price. So to keep the price from dropping in the secondary market. Now, they can't put in a bid that's higher than the public offering price, right? It's to stabilize, not artificially inflate the market. Once the IPO is finished, once they sold all their shares to ground floor investors, then the underwriter has to withdraw their bid, right? Just basically step away, and then it starts trading from normal but now. Well, I guess someone asks, who verifies if it's true or false? Well, nobody really does, but if securities were sold based on an untrue statement of material facts or omission of material facts, well, whoever got stuck with it could file a lawsuit against the issuer, against the underwriter, against the syndicate. Okay, now how do they do that? The statute of limitation is 2 years from discovery, but no more than 5 years actually after the violation. So if they made this discovery, they bought statements based on an untrue statement, and they find out about the same day, they've got 2 years to decide if they'll file a lawsuit. Well, what happens if 4 years went by and now they found out there was an untrue statement of material fact? Well, at this point, they've only got 1 year left to decide if they're going to file a lawsuit or not, a civil lawsuit. Okay. All right. I did come to this before. Restricted persons prohibited from buying IPOs at the IPO price. All right. And that includes members of the industry. That will include you. Okay. Once you're employed by a broker-dealer firm. So broker-dealer member firms. Okay. Remember, when the firm's a member firm means member of FINRA, right? That's a broker-dealer firm. Okay. Associated persons. Those are employees of member firms. So that will be you. Okay. Right. Their fiduciaries, including their lawyers and accountants, finders, right, who help the company, right? They found an underwriter to bring them together on that. So they're all involved here. Because remember, it's a public offering for the public, not for the industry. Portfolio managers, like mutual fund managers, cannot buy it for themselves, but they can buy it for their portfolios that they manage, because that's for their customers. Okay. All right. Now, what if there's a unsubscribed IPO? Okay, right? They bought 10 million shares to sell to their customers, and the customers only bought 8 million. What happens to the other 2 million? Okay, now this one says that the underwriter says disclose in writing. They said there were no buyers found. They made their best effort to do it, and the shares cannot be sold for 3 months. All right, now after 3 months are up, now they can turn around and sell the shares again. Okay. All right. Shares that the issuer designates for a specific person. Now, again, that can be things like officers or executives or directors as part of their compensation, but can't be a broker-dealer, can't be the people who work for a broker-dealer, unless they are family members or also employees of the issuer, or a fiduciary or the managing underwriter, like its lawyers and accountants. I did just mention stabilizing a new issue. Okay, so I just mentioned that before. I didn't. Okay, so there's a slide about it again. So the underwriter can stabilize the price in case it drops in the secondary market while the IPO is still going on, and only stabilize the price. Now, to do so, they must have a notice of stabilization in the prospectus. All right, keep in mind, remember, prospectus is full and fair disclosure of all material facts. So if it's not in the prospectus, it doesn't exist. Okay. Insiders also are prohibited from certain actions. An insider, okay, now who's the definition of an insider according to the industry rules? Is an officer, director, or 10% shareholder. Okay, right? Someone like a CEO, CFO, CTO, or director, someone who's on the board of directors. A 10% shareholder means anyone who owns 10% or more of the company's common stock. Well, these people are very likely to have, right, material non-public information. Okay, that's called or insider information. Now remember, it's not illegal to have inside information. It's illegal to try and trade or profit or avoid losses based on having material non-public information. So insiders, what can they not allowed to do? First off, they cannot trade based on non-public information, right? Things that are not known to the general public. That's what makes it inside information. Once it's known to the public, hey, so then it's fair game, right? And as soon as they put out the press release, right, it hits the news wires, the newspapers hit the newsstands, it's public information. They're not allowed to sell the stock short. That's like betting against your own team. Okay, and there's a thing called short swing profits. If one of these insiders buys the shares of the company, right, of the company they're insiders of, and then sells it within 6 months for a profit, they're not allowed to keep those profits. They have to be disgorged, which means they give it back to the corporation. They can't keep the profits for themselves. Now, they still might have to pay taxes on it, even though they couldn't keep it. All right, now insiders can have basically these trading plans, right? A plan for what they call a safe harbor, so it's not insider trading. So they might open a window, let's say twice a year, in which the insiders can sell a certain amount of their shares, but it's just known that they're doing so, right? It's that agreement that they'll be able to sell within that period of time. All right, when insiders do trade, and if they become insiders, that has to be known to the SEC, and they have to report their trades within 2 business days. And by the way, those reports are public information, so people can find out what the insiders are doing. In fact, some even say, follow the insiders. If you see insiders buying, there's only one reason they could be buying, so maybe you should be buying too. If you see insiders selling, is that necessarily a warning sign? Not necessarily. Right? People could sell for a number of reasons. They're rebalancing their portfolio. Okay, their accountant told them that, hey, you need to diversify. Okay, right. So there could be reasons. Now, insider trading, okay, is pretty serious stuff. It is a felony for civil penalties. Civil penalties is what they call, and that just means lawsuits. Okay, the civil penalty is what they call treble damages. Damages. Okay, treble means triple. That's 3 times the profits that they make or 3 times the losses they avoided by trading on inside information. Now, that's just the civil penalty. The criminal penalties can be fines up to $5 million, 20 years in jail, or both. Okay. Now, if a firm is trading as insider trading, well, you can't arrest the firm. You can arrest the people at the firm who made these decisions, and the firm could be fined up to $25 million. So as you see, the penalties here are pretty substantial. Of course, Martha Stewart. We all think of her. just sort of the poster child. It wasn't really so much the insider trading for her; it was the lying about it that got her in trouble. Okay, yeah. She told regulators one thing, but it wasn't so. Okay. By the way, there's another penalty here too. I don't think there's a slide for it. Nope, there's not. Okay, it's called contemporaneous traders. Right. People who say that they were trying to trade their stock, they were placing orders at the same time someone else played an unlawful insider trade. And they can say they were financially harmed as a result, and they can file civil suit too. So as you see, they get you coming and going on the whole insider trading thing. So I think the message we're getting here is, right, don't get any bright ideas. So what happens if you're in the elevator with the CEO, happens all the time, I know, and you hear him talking on the cell phone. And you hear him say, right, when our quarterly report comes out, we are going to get clobbered. Well, guess what? You're now in possession of material, non-public information. Now that you know this information, what can you do with it, and who can you tell it to? And the answer is no one and nothing. Okay, so I'm just checking our schedule here today. Okay, right, no one and nothing. Okay, well, you can tell your manager or compliance officer, but that's it. Otherwise, keep your mouth shut. And here's why. Because Regulation Fair Disclosure, okay, says that information, if material information to a limited group, right, like they're doing an analyst call or something like that, okay, it has to be publicized. All right, and if it's not publicized, then it is inside information, and these analysts can't go making recommendations based on information that was not been given to the public. Let me see if it's here. No, it's not here. So let me put this on here. All right, so Regulation Fair Disclosure, or FD, makes known what's known as the Tippy Doctrine, which means who gets busted for trading on material inside information? Everybody. The tipper, the person who gave this material information to somebody, and the tippee, who got this information and then did something they shouldn't do with it. Okay. Now, keep in mind, if there was no inside trade, right, there was no trading on this information, then there's no violation. It's not illegal to have inside information. It may be necessary. It's illegal to try and trade based on it. All right, as reporting companies, I mentioned, right, companies that file with the SEC are known as reporting companies. They have to report public information, right, to the SEC, right, which investors can generate. They file 4 reports per year. There's the annual 10K report, which is audited. Audited means it's reviewed by an independent CPA who says, do they agree or disagree with their results? And then 3 quarterly reports, which are unaudited, right? That's called Form 10Q, Q for quarterly, right? So what type of report? 10Q. You're welcome. When there's a major event happening that's going to have a big impact on the stock or the company, it also has to be reported on a form called 8K. All right, what kind of major events are that? Well, a change in the executive management, a change on the board of directors, a merger or acquisition. Okay, what else? Someone, I don't know, maybe senior executive level passes away. Anything that's major like that has got to be reported on Form 8K within 4 business days. And again, it's public information, which the public can look up, by the way. Oh, next, again, just in case it's on the test, I rarely see it come up, but the information is found in a public database known as the Electronic Data Gathering and Retrieval. EDGAR is SEC's database of information about reporting companies. Their Form 10Ks, their 10Qs, their registration statements, all available to be looked up. Okay. Our 8Ks are also on FDIC websites. FDIC is for banks. So I'm not familiar with FDIC. I've heard it on about FDIC. So I'm Tempted to say no, because I know it's the database for the SEC rather than the FDIC. But then again, I've never checked. I've never checked it out. Okay. Okay. All right. So what rules are there for member firms? Okay. Remember, a member firm means a member of FINRA, right? Right. As okay. And if you're in the industry, membership is pretty much mandatory. First off, the net capital rule. Net capital is liquid net worth. So, okay, also notifying broker dealers of their financial. So customers have to twice a year get a report about the financial condition of the company, of their broker dealer. I think we like to know that the company we keep our money with is is solvent. Okay. Firms must also segregate customers' fully paid securities, excess margin securities, more than 140% of the debit balance. By segregate means that they cannot commingle firms' assets with customer assets. Okay, may not commingle assets. Can't even keep them in the same bank vault. Okay. Now, customers' assets can be commingled together. They can keep them in the same bank vault, right? Because they keep records, of course, right? Who owns what? They can't mix it up with the firm's assets because what happens if the company goes under? And regulators have to step in and sell off the firm's assets. Well, if they've been commingled with customers' assets, it may be awfully difficult to figure out who's whose. Firms have to tell their customers on their statement balances their free credit balance. That means how much cash is available to withdraw or to be used in the account. And those funds, okay, you can call them up and request a check. All right, what happens if the customer sells the security, places a sell order, they don't have the shares in their account. They're supposed to deliver a paper stock certificate. Well, what happens if they don't deliver? Okay, now remember, they're supposed to deliver within 2 business days. That can be then extended 4 business days, but 10 business days goes by and that stock certificate hasn't shown up. They do a forced buy-in. You sold something, it didn't show up, they're going to buy it back in for you. And if you end up losing money because they bought it back in at a higher price you sold it for, that's how it goes sometimes. Okay, before going on to other regulations, I think it's also a fine time to take a little quick break and return at 10 past the hour. All right, and again, if you have anything you'd like to ask about, if you'd like me to go back to a previous slide, just please make your request. You can unmute, or you can just type it in the chat, and I'll reply appropriately. I'll see you in a few minutes. All right, are we still connected? Still live? Still hear my voice? Still coming through okay? Kimberly and Ashley, thank you. Okay, and Colby? All right, good. And Amy, thank you too. Okay, and Hannah? All right, just so good to hear, to know it's working. Okay, let's clear that off here. All right, next segment here is about other federal and state regulators. After all, there's other regulations involved too. All right, so some of them we've actually had a chance to mention regulation SHO. Okay, this is the rules for short sales. Okay, first off, all order tickets, right? Remember when you fill out an order from someone, you fill out an order ticket. Used to be, of course, on carbon piece of paper, but now it's done on computers. Okay, but when someone sells something, you have to mark it whether they're selling long or selling short. Selling long means selling something they already have, right? Hopefully for a profit. And selling short, which is an opening sale, when they borrow securities to sell them, and hopefully they're hoping that the price drops and can buy it back later. Okay, so regulation SHO says before they can place a short sale order, the securities must be located so that they can be borrowed and be able to deliver by the settlement period. If they can't be located, they can't process the short sale order. They'll just basically cancel the order. Penny stock rules. Okay, now the definition of a penny stock is an unlisted security. That means it's not listed on a stock exchange, over the counter, that's less than $5 per share. Now, you often would hear the term that says, as probably a more generic term, which is OTC, over the counter, non-NASDAQ. Okay, there are different levels of the over the counter market. NASDAQ being the highest level actually it's considered a stock exchange now, but that's the highest level. Well, there are other levels below that, and they start getting pretty obscure. But since they basically probably most likely go by a generalized name, over-the-counter non-NASDAQ, right? Doesn't qualify for NASDAQ listing. Less than $5 per share. Now, these are concerns to regulators because one of which, these stocks tend to be very thinly traded, right? There's not much of an active market for them. And yet, because they're such a low price, when someone does order them, they can buy or sell a lot of shares at one time. So even one single order on a penny stock can move the market just in and by itself. So we have to know that there's additional risks involved, and there are disclosure documents about trading penny stocks. So if the firm wants to sell with a penny stock to a new customer, they must get information about that customer and know that it is suitable to the person they recommend it to, right? That this is going to be a high degree of speculation. So do they understand how these operate market? Do they understand the risks involved? They also want a customer from a suitability statement signed before any confirmation, unless the customer is already established. So the customer will say, yes, I understand. They're basically attesting as to their suitability for them, that they believe that this is a suitable investment for them, and they're attesting to them, unless the customer is already established. Now, what's the definition of an established customer? It's either someone who's done a transaction with that firm for more than at least a year ago, or has done 3 purchases of penny stocks, of different penny stocks, by the say, at that firm, right? Done 3 penny stock trades before. Then they figure, all right, you already know what you're doing, and they already know your customer. Now, a risk disclosure document, again, you'll often hear talk about disclosure documents. They do like them, has to be provided to a customer who wants to buy penny stocks. So the document describes, okay, the bid and ask prices, about the quotes on them, the compensation earned by the broker-dealer, and also, if anyone does own penny stocks, they must receive a monthly account statement. Statements are generated on a minimum quarterly basis if they're inactive, they're not really being used. But with penny stocks, must have a monthly statement because of the nature of them, right? A very volatile nature of penny stocks. Even a small change in the price is a big percentage of the value. So we have to keep information up to date on a more frequent basis about the status of their investments. The Securities Investor Protection Act of 1970. The Securities Investor Protection Act created the Securities Investor Protection Corporation, which would be like what the FDIC is to banks, right? They're there to protect the customers of broker-dealer firms in case of the firm's insolvency. Insolvency means bankruptcy. So what the FDIC would be to banks, the SIPC would be to broker-dealer firms, except that the FDIC is a government entity, part of the government. The SIPC is a nonprofit organization which is funded by member contributions. So every year, member firms, members of SIPC, which nearly all broker-dealers are, have to kick in some dues, right? Some assessment, which is for their coverage in case the firm goes under. How much coverage does each customer have? Each separate customer covers up to $500,000, but only up to $250,000 can be cash. No more than $250,000 cash. The reason they limit cash coverage to $250,000 is so not to compete with the FDIC, because that's $250,000 also. Now, also it says that's for each separate customer. What do they mean by a separate customer? It's not necessarily each individual person. A separate customer is defined by the way the account is titled, the titling on the account. So if accounts have different titles, they're considered to be separate customers. One person may have multiple accounts, but if it's all titled under the same person's name, that's just one customer. A margin account, because someone have a cash account and a margin account. In a margin account is not a separate customer, but only the equity is covered in a margin account. Equity means, of course, what the account is worth, right? Assets, right? The value of the account minus any margin loan taken out of it. That's the equity. All right, so here it gives us an example. The customer has a cash account with $350,000 of $30,000 securities and $270,000 in cash. Now, the first $250,000 of that cash is covered, leaving $20,000 uncovered by SIPC. Now, then there's the balance. The remaining $250,000 coverage is available for securities coverage, but that, of course, would be, they only had $30,000, so their securities positions are fully covered SIPC. The next example says the customer has a margin account, $500,000 market value, but $100,000 debit balance. That was borrowed against it. Well, that leaves equity of $400,000. Only the $400,000 is covered. All right, so here's an example about a separate customer. Okay, the way the account is titled. So we have John's individual account. All right, so John, right, he's got an account in his own name. It's under his social security number. He's a separate customer with $500,000 SIPC coverage. Then we have John and Mary's joint account. All right, now this is in both their names, so that's a separate registration. So John and Mary is a separate customer, so that's another $500,000 coverage. Mary has her own individual account. So, right, that's her property. It's only in her name, so she's a separate customer. Then we have John's IRA and Mary's IRA. Now, an IRA, a retirement account, is its own separate registration too. So their IRA accounts are separate customers. So 2 actual people, but 5 separate customers for SIPC coverage. You might hear the SIPC sometimes. Okay, right. Now that's different from the FDIC. The FDIC is for banks. SIPC is for broker-dealer firms. FDIC is part of the government. Okay, and broker-dealer accounts are not FDIC insured. Okay. So by the way, which when you open accounts at a bank, right, you have to disclose, right, that they're investment accounts, not FDIC insured. All right. So that's one of the major differences here. By the way, the Securities Investor Corporation. So it only covers cash and securities. So if someone has things that are not securities, let's say like futures contracts, right, or commodities contracts, commodities and futures are not securities. That does not fall under SIPC coverage. There may be different coverage, but not SIPC. The Federal Telephone Consumer Protection Act of 1991, right, governs basically cold calls. Cold calls means no prior contact, or the word unsolicited calls. No prior contact has not been requested, cannot be made before 8 a.m. nor after 9 p.m. in the recipient's time zone. Okay, now by the way, for unsolicited calls, I used to work with someone who worked with another company before that one who says, during their training, they would just have them rip out pages of the phone book and call them up. All right, now that is an unsolicited call. That's cold calling. Any prior relationship, is considered is not considered a cold call. So, and that's a very generous definition. So if you put in a business card into a fishbowl at a restaurant, hoping to win a free lunch, that's prior contact. Now, if there is an established business relationship, we don't have to worry about that time zone thing. Okay, so not before 8 a.m. or after 9 p.m. So be cautious if you're East Coast calling West or West Coast calling East. Okay. When someone makes the call, that person must identify their own name, right, the firm they work for, the reason for the call, and a phone number or address where they can be contacted. And if the person who they call says, go away and don't ever call me again, they must go away and not ever call them again. So any number that's been requested has to be put on the firm's internal do not call list. Besides that internal list, the Federal Trade Commission, the FTC, also maintains a national do not call registry. So any list of names and numbers that they get for a cold call has to be scrubbed against the Federal Trade Commission do not call list. So if they don't say they don't want to get calls, don't ever call them again. All right, if you see their name on the National Do Not Call directory, you don't call them unless there's a prior relationship. Okay. The major regulation that oversees corporate bonds is the Trust Indenture Act of 1939. It basically says that any bond issue is that's not exempt from SEC registration, which means corporate bonds, right? That's more than $500 million, must have a trust indenture, right? Which is a contract between the issuer and a trustee who's appointed to basically be the go-between and look after the interest of the bond holders, of the investors. So this trustee is going to be the liaison between the bond issuer and the bond holders, including, for example, making sure that the corporation is living up to the terms of the trust indenture, right? The terms and conditions of the bond offering. Like, for example, if the bond offering, the indenture says they have to have a sinking fund. That means they have to put money into an account, right, into escrow every year, right, in preparation for when the bonds mature. After all, if they've just borrowed $50 million from investors, they got to pay that $50 million back when it matures. So they say, okay, you're going to have to put money into escrow until then. If the company defaults on the loan, right, if it was a secured bond, then the trustee will act to liquidate those assets and, right, and sell them off and use that money to make the investors whole again. All right, the Investment Company Act of 1940 is the major regulation of investment companies. Now, of course, investment companies means mutual funds mainly, but also, of course, face amount certificates, unit investment trusts, and closed-end funds too. So it goes a long way in defining and describing the three major categories of investment companies. And again, management companies, which means there's a fund manager, okay, then also defines the two subcategories, an open-end fund and a closed-end fund. All right, and the popular name for an open-end fund is a mutual fund. They're pretty much synonyms. Open-end fund and closed-end fund, open-end fund and mutual funds, pretty much the synonyms. The only reason I say pretty much is because there are some things that are categorized as open-end funds that aren't actually mutual funds. All right, also in 1940 is another major regulation, the Investment Advisors Act. So this described what is an investment advisor. And how's that different from a broker-dealer? You see, a broker-dealer is in the business to execute buy and sell orders on securities, right? Okay, and they make a commission or a markup for doing it. Investment advisors, however, they're in the business to give advice about securities, right, or for analysis on securities, right, or managing their customers' portfolios. Okay, and get some fee or compensation for the advice. Now, there's different business models about how to do so. Okay, now therefore a broker-dealer is not an investment advisor. If a broker-dealer gives investment advice, the advice is free, right? They get paid, right? They're paid on execution. Investment advisors are paid specifically for advice, analysis, or manage their customers' money for them. Now, broker-dealers that offer wrap accounts are also going to be duly registered as both broker-dealers and investment advisors. They can do that. They can be both as long as they have both registrations and fully disclosed to customers. Wrap accounts are offered by investment advisors, not broker-dealers. They get the name wrap account because everything is included. All services are wrapped by one single fee. So the pay one price includes everything. It includes the advice and money management services, the overhead and administrative costs, but the big one is it also includes all transactions. Instead of paying a separate commission for buy and sell, okay, for each trade, it's all including the pay one price. It's like the all-you-can-eat buffet. Okay, good. Now, who is not considered an investment advisor, by the way, is, as broker-dealers and banks, also newspapers, right, that are general circulation, or investment newsletters, right, publishers of investment newsletters, as long as the advice that they give in their newsletter is generic and not tailored to each individual subscriber, right? So if everybody who subscribes gets the same newsletter, they're not investment advisors. Okay. All investment advisors have to register with somebody. The smaller ones register in the states where they do business, and the bigger ones register with the SEC. When they're registered with the SEC, they're known as federal covered advisors. Okay, the difference about who has to register where, for the most part, is how much of the customer's money does the firm manage. If the firm manages less than $100 million of customer assets, they register in the states where they do business. If the firm manages $110 million or more, it registers with the SEC. And if the firm manages between 100 to 110 million, then the firm can choose whether or not to remain as state registered or switch over and register with the SEC, become federal covered. Okay, so it may register with the SEC at 100 million, must register at 110 million. Oh, actually, before I do that, the definition, how can you identify an investment advisor, is something called the ABC test. Okay, if the firm gives A for advice about securities, okay, so by the way, if they advise about things that are not securities, like whole life insurance, they're not investment advisors. Okay, do so as a B for business. So they don't even have to have any customers yet, because as soon as they hang a shingle on their door, they're in business. All right, and get compensation, C for compensation, for the advice. Okay, not for prescription, but specifically for the advice. Okay. So if it meets this test, right, meets this ABC test, that's the definition of investment advisor, and therefore must be registered as an investment advisor. Fingerprinting. Well, if you ever had a job with that, yes, because there's going to be a background check, right? And you're going to get your fingerprints taken, and they're going to they're going to go to the FBI and do a background check on that as well. Also, for anyone who handles cash or securities at the firm, also has to be fingerprinted. Okay. Now, by the way, when I was in the right, they still did my fingerprints on ink on paper. The next time I did it, though, it was scanned with that. They used a scanner instead, and I had a really hard time getting my fingerprints on the scanner. Okay, now, statutory disqualification. Right? So these are things that are an automatic no for registering with FINRA. First off, if somebody has been suspended or expelled from another self-regulatory organization, right? The stock exchanges, for example, the MSRB, the Chicago Board Options Exchange, these are all self-regulatory organizations. So if somebody else kicked you out, right? That's right. Registration denied with FINRA. Subject of an SEC order suspending or revoking registration. So the SEC says no. Caused a firm suspension or expulsion, like that one rogue trader that brought the remember, was it Lehman Brothers, I think? Yeah, brought the whole firm down. All right, you lied on your application, okay, or didn't properly fill it out. That's grounds for denial. Being denied registration, again, is a grounds for disqualification. Here's one, though. Convicted of any securities or theft-related misdemeanors or any felony convictions in the last 10 years are grounds for summary denial. Okay, now, by the way, notice I said convictions. Yeah, it's got right, convictions, not charges, arrests, or indictments. Got to be convictions is grounds for denial in the last 10 years. If it's been 11 years, okay, not grounds for denial anymore. They have to disclose it. By the way, there's no time frame on the disclosure, just convictions in the last 10 years, or a permanent, temporary, or permanent enjoin or a court injunction from being in the securities industry. Basically, a judge forbids you from being a court injunction, where someone is enjoined from being in the securities industry. Basically, a judge said no. So those are grounds for summary denial. Okay, now also, besides having federal registrations under the SEC, all the states also have their own securities regulations as well, or securities laws, that are collectively known as blue sky laws. So when you hear the term blue sky in this context, it refers to state securities laws rather than federal laws. All right, so by the way, the phrase blue sky comes from a judge's decision. I think it was like 1919. And the judge says people are being sold these investments that were worth only so many feet of blue sky, meaning people are being sold these worthless investments. Okay, so state regulators, at least most state regulators, have said if you want to do securities business in their state, you have to register in that state as well. Both the firm you work for, the broker-dealer firm, and the employee must all register with that state. Right? Most state regulators have said so too, and most states say if you want to do business in their state, you also have to take and pass the Series 63 exam, okay, which is the Uniform Securities Act State Agent Law exam. Okay, so to be an investment advisor representative, that means somebody who works for an investment advisor firm, they can take the Series 65 to be an investment advisor representative, and if they work for a combined company, both a broker-dealer and an investment advisor, then they take the Series 66 exam along with the Series 7 exam. Okay. Now, the note here, remember, about passing the SIE. Keep in mind that the test was split up into two tests. They have the securities industry essentials. This is like the overview. Anybody can sit and take the SIE, or anybody over 18. You don't have to be sponsored by a firm. But to complete your registration, you must also take your top-off test, which would be your Series 6 or Series 7, depending on the job you do. So now you do have to be sponsored, basically hired by a broker-dealer to take the Series 6 or Series 7. Okay. So yeah, passing the SIE, very good start, very important to do, but not enough to complete. Not enough to complete your registration. All right, with that, that covers our part about secondary market, the Securities Exchange Act. Oh, in case it ever comes up here, the Securities Act of 1933 is sometimes called the Paper Act, because this says that securities, right, a piece of paper that says you have a investment interest in something, have to be registered with the SEC. The Securities Exchange Act, okay, is sometimes called the People Act, because this says that the people in the industry, broker-dealer firms, registered representatives, the employees, the stock exchanges, also have to register with the SEC. Everybody in the industry registered with the SEC. So that's why I call it the People Act sometimes. All right, is there anything from this part that you'd like to get maybe a little more detail about? Now, okay, now the blue sky laws, for example, okay, maybe mentioned in passing on the SIE or the top-off test, the Series 6 or 7. But when you get to your Series 63, yeah, you're all about state securities laws. Okay, so that's going to be in a little more detail on that, but so something you have to look forward to. Okay, feeling okay about this so far? All right, thanks, Kimberly.
Sounds like life is treating me right.
All right, thank you, Ashley. Okay, thank you, Amy and Karina. Awesome. Okay, very good. Well, tell you what, we still got about, 10, 15 minutes here or so. Let's go ahead and pull up another. All right, let's play Family Feud. All right, first question. A 40-year-old is not covered by a retirement plan at work. What is the maximum contribution to a traditional IRA? Okay. A, the current maximum allowed by the IRS, which will all be deductible. B, nothing because this individual has no retirement plan at work. C, current maximum allowed by the IRS plus catch-up amount, none of it deductible. Or D, current maximum allowed by the IRS, none will be deductible. What do you think? Okay, right. Because this person does not have a retirement plan at work, they can make the maximum allowable contribution, which is set by the IRS, all of which is deductible, right? Fully deductible because they don't have a qualified plan at work. Now, because he's age 40, not age 50, the catch-up provision does not apply. Okay, but yes, will be deductible in a traditional IRA. That's the big deal, right? Because you get a tax deduction on the money you put in. They're funded with pre-tax dollars. Had this been a Roth IRA, that would be different. If the person was covered with a retirement plan at work and also his income was above a certain level, then the contribution might have been partially deductible or maybe full or maybe non-deductible at all. Okay. If you need any clarity about that, please let me know, okay? Oh, the Amazing Pelicans is here? Okay. All right, let's go to our next question. What's a big advantage Roth IRAs have over traditional IRAs? A, there are no penalties for early distributions. B, there are no income limits. C, distributions are normally tax-free. D, contributions are tax-free. The big advantage, of course, is that distributions are, in fact, normally tax-free as long as it meets guidelines. We talked about that, right? Age 59 and a half, and have the Roth IRA open at least 5 years. Yeah, then the distributions are exempt, right? Totally tax-free, both principal and growth, totally tax-free. There are penalties for early distributions before 59 and a half, but there are no RMDs, no required minimum distribution, because they're funded after tax. The IRS already got its cut. Okay. There are income limits, by the way, with the Roth IRA as well. So if someone's income is above a certain dollar amount, the amount that they can put into a Roth becomes smaller and smaller until it's the upper end of the range. I don't worry about memorizing what those numbers are because they potentially change every year. Just know that that's how it works. That's right. There's no RMD for Roths. That's correct. Right? They're funded after tax. The IRS already got its money, so they don't care when you take it out of a Roth IRA. Says you never really have to take it out. Truth is, no, you never really have to take it out. How about that, huh? Okay, well, we got everyone's on the board. Oh, thanks, Karina. And Amy moving into an early lead. Let's check our next one. Which of the following are true of both qualified plans and non-qualified plans? A, contributions are tax deductible. B, contributions are not tax deductible. C, the accounts grow tax deferred. D, tax on interest and dividends are deferred but not on capital gains. What's common between them is that the accounts grow tax deferred, which is still a big advantage. Qualified plans like 401ks qualify under IRS rules for an upfront tax deduction. They're funded pre-tax. Things like annuities, however, are non-qualified. They don't get upfront tax deductions, so only the growth is subject to tax when they take the money out. But both of them grow on a tax-deferred basis, and that's the big advantage that they have, right? Because when you let your money grow and compound so much faster when you don't have to take out any for taxes. Yes. Okay, does that make sense? Okay. In a qualified plan, the contributions are deductible. In a non-qualified plan, the contributions are not deductible. Okay, but all the accounts grow tax deferred. Amy's on fire and a really good lead now. Let's try our next one. Contributions to an IRA can be made for up to which of the following dates? A, the extension deadline October 15th of the year after the contribution year. B, December 31st of the year for the contributions for. C, April 15th of the year the contributions for. Or D, April 15th of the year following the year the contributions. It is April 15th of the following year. That's it, yes. So it's the tax filing deadlines. So we can still make contributions for tax year 2023 all the way up until April 15th of 2024 and still count for 2023, still count for a tax deduction. Yes, okay. Okay, no, not December 31st, not for IRAs. Things like company-sponsored retirement plans like 401ks, yeah, then it is. All right, Kimberly made a big move up here. Next question. Who is responsible for meeting the desired returns of a defined benefit plan? A, the custodian. B, the Pension Benefit Guaranty Corporation. C, the employee. D, the employee. I think that should be employee. All right. Yeah, it should have been the employer, so my apologies for the typo. But yes, in a defined benefit plan, that's like a pension plan, which means, right, you know what your retirement benefit is going to be. There's a formula. If you work for the company for so many years, you get so much % of your salary when you retire as an annuity. Okay, so it is the employer who's responsible. So my apologies for the typo. So I can't count that against you. Pension Benefit Guaranty Corporation is there to protect defined benefit plans in case the employer goes bankrupt. And the custodian, well, they're just basically the financial firm that holds the assets. They're not actually responsible for meeting the contributions to a defined benefit plan. Okay, Karina moves up real big. Let's check our next one. Who can contribute to an IRA? A, anyone with earned income under the age of 59.5. B, anyone with earned income under the age of 72. C, anyone with earned income. Or D, anyone with earned income not covered by an employer-sponsored plan. Okay, by the way, B should be changed to 73 now, though the law just changed. Okay. Anyone with earned income can contribute to an IRA. Earned income means wages, salaries, tips, commissions, and bonuses. Okay, anything you get from a job or running a business. No, not under age 59.5. Remember, 59.5 is the is the standard retirement age, where they can withdraw from an IRA without penalty, but they can still contribute. Okay. Sorry. Oh, Kimberly, your hand is up.
Yeah, isn't there income limits though?
No, there's not. Not for an IRA. Okay. Now, the only thing is whether the IRAs can be deductible, can be deducted. And if someone's already contributing or they're participating in a qualified plan at work and their income is above a certain amount, then the amount that they can deduct becomes smaller and smaller. But they can still make the full contribution and still take advantage of tax deferred growth.
Okay, thank you.
Sure thing. Colby moving right on up. Let's go to our next one. Which of the following is an acceptable investment for an IRA? A. Gold coins minted in Switzerland but sold in the U.S. B. A mutual fund specializing in speculative bonds. C. A collection of medieval manuscripts and art. D. A universal variable life insurance company. So what is acceptable in IRA? Most everything is actually, including mutual funds, even if they're speculative bonds or high yield bonds. No, those are okay for an IRA. What you cannot do is art or collectibles. You cannot do antiques, things like that. You cannot do life insurance in an IRA. And you cannot do, the only gold coins you can do are U.S. minted gold coins. Gold coins minted in Switzerland, no, they're not U.S. minted. So American yield gold coins, yeah, those you can put into an IRA, but that's the only collectible you can have in an IRA. Okay, and municipal bonds, never in an IRA either. All right, Alicia moves up. Let's try our next one. Which of the following retirement plans does not require required minimum distributions once the participant has reached age 73? It's 73 now. The law changed. A, Roth IRA. B, 403B. C, 401k. Or D, traditional IRA. We kind of discussed it recently. Hey, great, right. A Roth IRA does not require required minimum distributions, and that's because it's funded with after-tax money, and the IRS already got its cut. So, see, with the traditional IRA or 401k or 403b, they're funded with pre-tax money, right? Haven't paid taxes yet. Grows tax deferred, so the IRS is still waiting around for its cut. Now, they'll wait for it, and they'll wait a long time. In fact, it's now up to age 73, but they won't wait forever. So at some point, you must start taking required minimum distributions. Colby's 3 in a row. Awesome. Karina's moving up. Next question. At what minimum age can retirement withdrawals be made from an individual retirement account without a penalty? Is it A, 62 years old, B, 65 years old, C, 72 years old, or D, 59 and a half years old? Hey, bullseye, right? 59 and a half. Okay, is the standard retirement age, which means they can withdraw from an IRA or a retirement plan. They'll still pay taxes on the distribution, but there's no 10% penalty. Good. Okay, I got to figure lots of people. Kimberly's moving up, and Alicia's 4 in a row. Wow. Who is responsible for meeting the desired returns of a defined contribution plan? A, the employee. B, the Pension Benefit Guarantee Corporation. C, the custodian. Or D, the sponsor. It's the employee who's responsible for a defined contribution plan. A 401k is a defined contribution plan. You know what goes in, you don't know what comes out. So now the investment risk is now on the shoulders of the employee, right? Not the employer. Yes. Sponsor, by the way, that means the employer, right? That's the company, right? The sponsor of this retirement plan. The Pension Benefit Guarantee Corporation is only for pensions, for defined benefit plans. Okay, so yeah, that's why, so it's the employees responsible for funding their defined contribution plans. Well, Alicia's just rocketing up with 5 in a row. Which of the following are true of qualified plans, but not true of non-qualified plans? A, the plan cannot discriminate. B, all withdrawals are tax-free. C, all withdrawals are taxable above cost basis. Or D, the plan may discriminate. Plan may not discriminate. Right? To be a qualified retirement plan has to meet the rules of ERISA, Employee Retirement Income Securities Act, which says a plan may not discriminate in favor of highly compensated employees, meaning plans can't be top-heavy to like managers, executives, and the people who make the most money. Okay. In qualified plans, no withdrawals are taxable. Withdrawals are taxable, right? Because they got a tax deduction going in, so everything they take out is taxable. A non-qualified plan, the withdrawals are taxable above cost basis, meaning the growth is subject to tax. The cost basis, what they put into it, already paid taxes on it once, so no need to pay taxes on it again coming out. Okay, Kimberly moving into second place. What is the penalty for not taking the required minimum distribution for the year? Now, this is going to be an old rule, so we'll have to work with this one. A, 25% of the annual contribution limit. B, 25% of what short of what should have been taken. C, 10% of the annual contribution limit. Or D, 10% of the annual limit that should have been taken. Sorry, this is actually the new rule. Yeah, okay. The new rule is 25% of what should have been withdrawn but wasn't. Now, the old rule used to be 50%. All right, it was really severe. They changed that recently. It's now 25%, but that's still a pretty severe penalty. If you're thinking 10%, that is the penalty for a premature distribution prior to age 59 and a half. Okay, remember, they'll try and mix you up sometimes with those numbers. Okay, our next one. Each of the following investments and practices are deemed ineligible for an IRA or any other retirement plan except A, variable annuities, B, margin account trading, C, life insurance, or D, investment funds. Okay, so this is an except question, which means which one is actually okay. And by the way, even that, the variable annuities, it's okay, but kind of like this still raises an eyebrow. All right, they're not allowed to trade on margin. You cannot have margin on a retirement account because you cannot borrow against a retirement account, which you may have to meet a margin call and deposit more money over and above the contribution limits and face penalties. Can't do collectibles, can't do life insurance. Annuities are okay, but you cannot double dip the tax benefits of an annuity inside an IRA. So if they're getting an annuity for an IRA, it's got to be for non-tax reasons. Probably because, of course, the lifetime income guarantee that an annuity offers. Next question is, what is the penalty, if anything, or if any, for over-contribution to an IRA? A, no penalty. B, 10%. C, 6%. D, 50%. For over contribution is a 6% annual penalty on the amount of the over contribution, right? There are contribution limits, $6,500 this year. If someone puts in more than that in a year, they'll be subject to a 6% penalty on the excess until that amount is withdrawn. 10% again, that is the premature distribution penalty. 50% is the previous, right, penalty for failing to take required minimum distributions. It's now 25%, it was 50. Okay, next one. Who benefits most from a defined contribution plan? A, older employees. B, all benefits are the same. C, employees with fewer years left to work. Or D, younger employees. a defined contribution plan, right, that means the employee puts in money out of every paycheck. There may be a matching contribution on top of it, and it's the employee who picks the benefit, the investments. Well, the younger employees with more time until they need it, right, are going to better benefit from the amount of time that their money's working for them. Think of it this way: older employees are the employees with fewer years left to work. So the red and the yellow one kind of cancel each other out. And no, benefits are not all the same. That's why they need these different plans. All right, last one is who benefits most from a defined benefit plan? A, older employees. B, younger employees. C, all benefits are the same. D, employees with more years until retirement. Okay, there you go. Okay. Yes, older employees benefit from a defined benefit, a pension plan, because they'll know exactly what they're supposed to get. Now, keep in mind, by the way, younger employees are the employees with more years until retirement because they've got more time, so their benefit from a defined, they're good for a defined contribution plan. Older employees defined benefit because they know exactly what their benefit's going to be. All right, let's check it out. And who's on the podium? In third place, bronze medalist is Alicia. In second place, silver medalist is Katie. And in first place, gold medal and Olympic champion, Kimberly. Here it goes. All right. Okay. Didn't get all the answers on the go. We went over this because we want to make sure we're good with the details. All right, let's go ahead and close this one out. Close that one. Okay. So this wraps things up again for everyone. Thank you, Kimberly. So we'll see you again on Wednesday. This is a great time. Please get caught up on any back on materials. So, I see when with the this test you've taken. So you want to be up where at this point taking Mastery Exam 2 if you haven't already. And again, do encourage you. You don't have to take those quizzes just once. I encourage you to keep taking them for more practice and more practice and more practice. And as I said, I'll always take your highest score and give you the points for your highest score. Okay, in your final grade. All right, my pleasure, Colby and Ashley, and we'll see you again next time. Again, please feel free to contact me if you need anything or have any questions, and my offer to you for a free phone call still stands. Take care, everyone. See you soon.